Welcome to this video in which I'm going to discuss the VAT implications of buying fixed property. Now, this video is not going to go into details around every single section that I might talk about here, but we will look specifically at the timing of claiming your input tax as a buyer. The buying of fixed property and the VAT implications thereof is a very, very popular topic to be examined and is often asked as a discussion type question. So let's jump in. So what we can see on this slide is the two broad situations which you need to be familiar with, and this will determine how we claim our input tax. So again, we're not going to be looking at the seller in this case, we are going to be looking at the buyer. Now, the two broad categories that you need to be aware of is, and what determines our rules, is whether or not the seller raised output tax. So this will typically be if the seller is a registered VAT vendor and they sold the property in the furtherance of an enterprise. Now remember, guys, the furtherance of an enterprise, the selling of property, doesn't mean that they need to be a trader in property. If, for example, a company that manufactures t-shirts sells the land and buildings, that will also be a situation which they will have to raise output tax. Situations where there will not be output tax raised will be, for example, if it's a VAT vendor, but the fixed property was used for exempt purposes. Okay, so the seller raised output tax or the seller did not raise output tax. Those are two broad categories and situations that you need to be aware of. Now, if the seller raised output tax, you will claim the output tax raised by the seller as input tax. So just very simple, let's say that the seller, this is the sales invoice. Let's say that the seller sold fixed property to you and the sales amount excluding VAT was $1 million. The VAT on that is 15%. So the total that you will pay is 1.15 million. What will you claim as the buyer of as VAT in? The 150,000 rands that's on the sales invoice. So that is what you will claim. If the seller did not raise output tax, then if you had to look at this VAT invoice, it would not have any VAT here. So what would it say instead? It would say just a null there because it's not a VAT vendor, and the total would be $1 million. Now, if the seller did not raise output tax and you buy it from them, this will be the same situation as claiming input tax on second-hand goods, which is discussed in paragraph B of input tax definition. And this will be a situation where there was no output tax charge. So paragraph B of the input tax definition in section 1 talks about a situation where you can claim what they call notional input tax on second-hand goods on which no VAT was charged. Sometimes we refer to it as, or what's commonly referred to as claiming second-hand goods from a non-vendor, but it doesn't have to necessarily be from a non-vendor. If it was a seller that is a VAT vendor, but did not charge output tax because the seller is exempt from it, for example, in that transaction, that will still be applicable. Now, if that is the case, remember, and I'm not going to go into all the rules here, but if you can claim notional input tax, you will use that amount excluding VAT as if it included VAT, and you will then calculate the notional input tax on that. And in this case, that would be 130,434. It always, remember, when it is notional input tax, you multiply it by our tax fraction. So you treat it as if it includes VAT. I know it doesn't include VAT, you can see it there, but you always treat it as if it does. That's just a quick little tip on second-hand goods. Okay, so those are the two rules there, just about what the amount is. What is the timing of it? And this is where it gets a little bit more tricky. The first thing I want you to see is both of the timing is discussed in section 9.3d. And that tells you that the timing for VAT purposes, so when is the timing for this transaction? It's the earlier of when it is registered in the deeds office or when payment takes place. So whichever one happens first. But what is important for you to understand is, although this is the timing of the actual transaction for VAT purposes, section 16 in both instances overrides that rule and tell you, yes, sure, that's the timing, but when may you actually claim that input tax thing? And what does section 16 tell us? So you'll see there's slightly different references here for section 16, depending on whether the seller raised output tax or if the seller did not raise output tax. So if the seller raised output tax, you can claim the input tax to the extent that the seller has been paid. So you ask yourself, how much has the seller been paid? On that amount, you can then claim input tax. So if you pay the seller over 5 months, 1, 2, 3, 4, 5 months, each month you will claim as it is paid. However, if the seller did not raise output tax, then the rule's a little bit more complicated. It says you can only start claiming once the property has been registered in the name of the buyer, and then only to the extent that the seller has been paid, which is the same as that rule there. So the big difference between these two are, when the seller did not raise output tax, you have to look at the date of registration. That determines when you can start claiming. And only then do you look at how much has been paid. So let's go and see it as a little example. So X Limited purchased a fixed property from ABC P2I Limited on the 1st of March. In terms of the sales agreement, X Limited would pay ABC P2I Limited as follows. On the 1st of March, there's a deposit of 1.5 million. Then on the 1st of April, 1st of May, and 1st of June, 500,000, 500,000, and 500,000 is paid. The property was registered in X Limited's name on the 1st of May. So just to show you there, on the 1st of May is when it is registered. So the required says, indicate the amount of input tax that X Limited can claim and the date on which it can be claimed if A, ABC P2I Limited is a VAT vendor, and B, ABC P2I Limited is not registered as a VAT vendor for VAT purposes. So I just made it simple here, but I want you to just be sure and clear. I'm going to say here, thus output tax was charged. That's what my intention is here. And over here, output tax was not charged. Okay, so let's fill it in. So if the seller is a VAT vendor, our rule says that you can claim to the extent of payment. We don't care about when it was registered. So on the 1st of March, 1.5 million is charged. So on the 1st of March, you could claim 1.5 million times 15 over 150. On the 1st of April, May, and June, each of those 500,000 was paid. So you would claim 500,000 on each of those. But what happens if the seller is not a VAT vendor? So in B, remember the rule then says you must look at when the person has been, or when the property has been registered in the name of the buyer, and only then can you claim to the extent that the seller has been paid. So this property was registered on the 1st of May, just as a reminder. So on the 1st of April and on the 1st of March and the 1st of April, the property had not yet been registered. So we can't claim anything on the 1st of March, we can't claim anything on the 1st of April. Then it gets registered on the 1st of May, and 500,000 has been paid. So how much have we paid up to now? We've paid 1.5 million deposit, plus 500,000 in April, plus 500,000 on the 1st of May. So you can claim 1.5 million, plus 500,000, plus 500,000, times 15 over 115 on the 1st of May. Because this is when it is registered. Then it has now been registered, so on the 1st of June, when we pay our next 500,000, we just claim it as it is. So make sure that you can see the difference between these two. That's quite significant. And then just the last thing, something to think about. What happens if the buyer took out a mortgage loan with the bank? That would mean that the seller would be paid immediately. But then the buyer would have to pay the bank back over a period of time. So let's say the buyer took out a loan of the bank, and then a mortgage loan, and I'm going to say over 20 years. So for 20 years, each month, the buyer has to pay the bank for that loan. How would you then claim the input tax? This is not a tricky question, but it's important for understanding. You have to look at the extent to which the seller has been paid. If you take out a mortgage loan, the seller is paid immediately in full. So on day one, when the seller is paid, if the property has been registered in the seller's, in the buyer's name, you would be able to claim the full amount. Remember again, if the seller raised output tax, you don't have to worry about when it has been registered in their name. You just claim it when the person is paid. So that's on day one when the bank pays them. If the seller did not raise output tax, you wait until the date of registration in the buyer's name, and then you claim everything that has been paid. And that's it for fixed property. When we're looking at the timing rules, like I said, guys, it's an important topic for tests, and exams often asks the discussion question. Make sure that you know it well.